We've got another very busy week coming up, and the US presidential election on the 8th of November is likely to grab all the headlines. There are three things in particular to remember here. Regular viewers, sorry, you may have heard them before, but I promise to be brief. First, it's not just the presidential race that matters. You need to check out who wins the House of Representatives and the Senate, both currently controlled by the Republicans. A repeat of this could block any policies Hillary Clinton may have in mind, on the domestic front anyway, or for that matter Donald Trump, as he's not exactly uniformly popular with his own party either. Second, the US stock market has historically done better, on average, in the first year of a new Democrat presidency than a Republican one. Our analysis of all 17 elections since 1948 show an average first-year gain in the Dow Jones Industrials Index under 8 Democrats of 13.2%, against an average drop of 1.2% under 9 Republicans. Third, the Dow has gone down all 4 times we've switched from a Democrat to a Republican. Just remember though, all of these figures are historic averages, the underlying ranges are quite wide, and also that the past is, well, no guarantee for the future. Now, moving on to company news, we've got 14 FTSE 100 firms releasing trading updates of some kind or another in the coming week. These include, in a chronological order, Megabank HSBC on the 7th, Retail to Foodstuffs Group Associated British Foods on the 8th, Burberry, Sainsbury and Utility SSE on the 9th, and AstraZeneca, National Grid and ITV on the 10th. But for me, the stock that could really cause a fuss in the week ahead is High Street bellwether Marks & Spencer. The FTSE 100 constituent is due to release its interims on Tuesday, the 8th of November. The stock has, frankly, been a horror, with the shares trading at close to 5-year lows as I sit here. And I think there are 3 reasons why the stock is badly out of favour. First, the trend in like-for-like sales remains weak in clothing and general merchandise in particular, with July's first quarter like-for-likes at food and M&S.com also disappointing as well. This chart shows the year-on-year trend at general merchandise, where boss Steve Rowe really has to start showing improvement. Second problem, well, the long-term earnings growth record is poor. Analysts have continued to cut their forecasts, and they now expect M&S to earn £595 million pre-tax for the year to April 17 and £583 million for the year to April 18, numbers which mean the firm will be earning less in 2 years' time than it did in 2006, assuming the forecasts are correct. And third, the problem, the pound is weak. Sterling's been the key victim of the post-referendum pre-Brexit period, plunging to multi-decade and multi-year lows against the dollar and euro. This could be bad news for M&S, as it may increase the firm's import costs, squeezing margins. That may partially explain why a strong pound has tended to coincide with a strong M&S share price, and a falling pound with a falling one, at least over the last 20 years. So those are the 3 key issues to watch with these interims: general merchandising like-for-likes, the impact of the pound, and whether profit forecasts will keep grinding lower. Overall, the news, frankly, is likely to be grim, but then you have to decide whether a forward PE of just 11 times and a dividend yield of around 5.5%, excluding June's special payment, already factor in a lot of this bad news. As a final point, therefore, do keep an eye on that dividend. M&S paid 6.8 pence a share at the first half stage last year. Thank you for watching, and I look forward to seeing you next time.